If you had invested $100 10 years ago in shares of Google or US dollar or even gold, what did you really invest in? Savings is a technique to store income for deferred consumption, while investing to make profits is also another way to increase your savings or better your lifestyle. If you had invested $100 10 years ago in shares of Google or US dollar or even gold, what did you really invest in? Think about it for a second. What did you really invest in? You invested in Google's shares, then you invested in equity or stock. As discussed in the previous segment, cryptocurrencies have a major advantage over other assets in terms of accessibility, as they offer a more inclusive approach in onboarding new users and is obviously a much open market. But it also means that it is important to understand what all other assets are available globally for investment purposes. Some other major assets available globally are equity or the stock market, fixed income or bond markets, foreign exchange or currencies, or it might be referred to as cash markets, also commodities like oil, property or real estate. Having understood what all options do you have as an investor, now let us understand what are the key differences between all these assets and cryptocurrencies. Cryptocurrency markets are BTC dominated, that is Bitcoin dominated, which means that price fluctuations of Bitcoin also impacts a majority of cryptocurrencies. Also, owing to its small size of the market, there is high volatility. But wait, what exactly do we mean by the term volatility? It is a simple mathematical concept of standard deviation which we all studied when we were in school. Standard deviation is the double-sided movement from the mean, which it means that cryptocurrencies rapidly move from their standard deviation, which is not seen in many other asset classes. This also depends on the volume versus market capitalization, and as cryptocurrencies will gain more and more market cap with adoption, volatility will keep decreasing over time. Moving on, cryptocurrencies are traded round the clock, unlike most markets that have a fixed time for trading to take place. Some might argue that cryptocurrency markets are less sophisticated as compared to the other asset classes, offering multiple financial instruments. On the contrary, cryptocurrency market has seen a surge with decentralized financial services emerging and bringing new innovative financial instruments to match the traditional financial markets. There are also shorter cycles in the market. And what exactly do we mean by a market cycle? Let's get to know that. Market cycles, also known as the stock market cycles, is a term that refers to trends or patterns that emerge. During one cycle, some assets tend to outperform others because perhaps their business models are more aligned with conditions for growth with respect to time and other socio-economic factors prevalent in the market, both locally and globally. One market cycle is the period between two latest consecutive highs or lows, highlighting a fund's or asset's performance through both an up and a down market. The market cycle of other asset classes like equity, etc. could range for several decades or at least a couple of years. But in the cryptocurrency market cycles, it's just several months, so the market cycles are a lot shorter than usual markets. So to sum it up for you, cryptocurrencies outdo any other asset class that there are in the market today. It is highly volatile, works 24/7 and has a shorter market cycle. By its virtue, it outperforms any other asset class out there. And all this talk of Bitcoin as a market leader remains incomplete without addressing an important topic, that is the market share. Let's have a look at what is the market share of cryptocurrencies and how much they exert over other asset classes in our next segment.